Hey everyone, I'm super excited to be hosting this session on carbon pricing. So I know we're slightly post-lunch here, so a little bit soporific, but hands up, who knows what happened to UK coal power last week? Any hands up? Oh, hey, look, we're on an honorable audience, right? So the UK was the first country to have coal power over 140 years ago, and it's now the first country to exit coal power. There is no more coal power. They're also the last blast furnace also closed down. So in this session, we're going to hear from Brian Hensley of Kaya Climate Policy Advisors, who's going to do a short presentation. And then we're going to move into a panel discussion and take questions from the app Slido. So if you've got any questions, do put them in, and we will try and take as many of them as possible. I also realized this after lunch, so a couple of polls to get us started. First poll, please. How are people feeling about the state of carbon pricing today? Are we feeling positive or negative about its future direction? Are we feeling more neutral? If you're not feeling like the app, you could just put your hands up if you're feeling positive about it. That's not many hands. Or hands up if you're feeling negative about it. There's probably a few more on the negative. All right, so we'll see if we can change your minds or not as we're going through. Great. So I don't know what have we said on the polls? Are they coming up? Oh, yeah, negative. That's almost 60% negative, 30% neutral, less than 20% feeling positive about it. So that may be the political reality. All right. Okay, second poll that we're going to do. We're interested in knowing what you guys in the audience think are the biggest challenges on carbon pricing thinking. Is it political? Is it business? Is it monitoring and data issues? What sort of resistance are we doing? So with the second poll, let us know what you think is the biggest challenges facing carbon pricing today. We'll put some up. So we've got kind of political resistance, business resistance, monitoring and data issues, public resistance, things like that. Clear win for the politics and the political. We've got a little bit on short-term focus on things, but political is the big one. Okay, great. And so a quick reminder here on why economists particularly think carbon pricing is so important. So first of all, it's a market-based approach. So carbon prices uses market forces to reduce emissions and incentivize businesses and individuals to find the most efficient ways to lower the carbon footprint. And it kind of targets the root cause. That's why economists like it. It's also an incentive for innovation by making carbon emissions more costly. And kind of on the moral point, it slightly suggests that the polluter pays principle. In theory, it ensures that those who are responsible for the pollution bear the cost. But there are quite a few challenges. There's a political economy challenges. The tax is considered regressive on low-income households. Without a global system and some global coordination, many companies are worried about global competitiveness depending on individual nation states. It's also hard to set a price. There's a little bit of disagreement on this. If it is too high in areas without a good substitute, it's maybe considered just simply a tax. And if it's too low, you're not going to see any meaningful change. And finally, the public don't want to see higher costs. They don't like seeing higher energy costs. You might need complementary policies, and there might be a kind of time lag before we see a kind of effect with that. So with that as our introduction, I'm going to hand it over to Brian to give his presentation.
Thank you, Ben. So I think I'm going to be speaking to some people who may agree with a few of the things I have to say, but first let me say it's a pleasure being here to set the scene for our discussion with my distinguished panelists. And I'm going to take us through a quick journey of where carbon pricing has been, where it is now, and offer myself up as a sacrificial lamb to figure out maybe where it's going in the future. And there are three main points I would hope to leave you with today. And one, as Ben alluded to, is that carbon pricing does hold the power to significantly reduce greenhouse gas emissions, but the higher that price goes, so too the political ramifications of raising that price. The second point is that the EU is very important in this debate. It was a first mover in carbon pricing, first mover in trade in carbon pricing. But the question that we have to ask ourselves is this a first mover advantage or is this a first mover disadvantage now? And has the most powerful weapon of the EU when it comes to carbon pricing already been deployed? And the last point is that carbon pricing is evolving. And to look where it's going, you need to look, or we should look past just the theoretical impact on emissions profiles and into the murkier waters of politics, geopolitics, and the economics of industrial policy. So this is where we've been. This is 35 years, and the big events are the EU introducing its emissions trading system in 2005. A decade later, Japan introduced its carbon taxes. North America has been sprinkling in some taxes as well. And then China introduced its own ETS in 2021. Now this year, China is expanding its ETS, as I'm sure many of you know, to cover emissions equivalent to 60% in all of its sectors. And so for the first time in history, we're going to have over 25%, I think it's around 26 or 27% of global greenhouse emissions covered by some form of carbon price. So that brings us to 75 schemes, which we have now. These are roughly divided between ETS, or what we call cap and trade, and also the other half is carbon taxes. There's another 30 which are under development. As we mentioned before, that's about 13 gigatons of CO2 equivalent of emissions covered. And we have one active CBAM, the EU, albeit only in the reporting phase. And we have 8 other countries contemplating some form of CBAM, and the map on the right shows you where those are. Now, what is the price in these carbon schemes? Well, first of all, there's many prices, and they have a huge range. They range from 50 cents in Indonesia to $167 in Uruguay. The average price is trending higher. This is very encouraging, but it's also a little bit deceiving. Why? Because governments are giving money to the companies to pay for the tax. And this is important because the economic impact has not been passed to the companies, by extension to the consumers, and by another extension to the politicians who are implementing this. In any case, the World Bank is estimating that 1% of global emissions are priced above the recommended level. I wanted to spend just a couple of minutes on how the EU ETS works. Many of you will be familiar with this. It is a fundamentally important topic to grasp. And so what was happening is that the EU sets a maximum limit or cap on the aggregate amount of emissions in certain sectors in the trading bloc. Those sectors are by and large energy-intensive industries, which make tradable goods, think steel, aluminum, cement, fertilizer. And a company who emits more than its allocation can go into the market and buy an ETS allowance from another company who emits less than its allocation. Now that cap, importantly, is designed to decline over time, down to zero. And the red line on the right shows the previous iteration of this, going down to zero around 2060, and the blue line is the current most recent iteration of that. And it's worthwhile thinking about what that means, that without any changes to this limit, this maximum limit, by 2040, emissions would not be allowed, as if that were maybe possible in these sectors, and nor will allowances be available on which to trade. So because this puts many EU industries at a particular disadvantage relative to their global peers, after all, they could just pull their stakes up, go somewhere else and produce where they don't have these costs. The EU is bringing into place a mechanism, which we all know is the CBAM, in an attempt to level the playing field. The CBAM is a tax which is based upon the amount of emissions which are produced in the manufacture of a good in another country. So to put it in as simple terms as I can describe, if you're an EU importer of something made in Indonesia, where the equivalent carbon price is, let's say, €1, and the EU ETS price is 60, then upon importing that, the EU company will have to pay the difference between those two. And as that gets passed to the consumer, it reflects a higher price for the Indonesian company, which essentially means it becomes a tariff. Now, right now we're in a transition phase on this, but starting in January 2026, the free money, which the EU is giving to the companies in the EU, not all of them, but most of them, now is going to be taken away to be replaced by the requirement to buy these CBAM certificates. It's going to be a proportional decline in the amount of free money, taking away the drip, and proportional to the amount of CBAM certificates they have to buy. And at first, you can see in the first few years, it's relatively gradual. It goes up 10%, but then it quickly ramps up. And by 2030, half the free allowances are gone. By 2034, they're all gone. Companies will have to use all of their own money to pay for these taxes, or the difference in the taxes. Now, I'll pause here just to list a few of the well-documented issues with the CBAM. None of this will be a surprise to most of us. Not all countries outside the EU have the willingness or the ability to have a carbon price, notably the US. Secondly, it has been argued that a unilateral CBAM from the EU could be said to contradict the principles of common but differentiated responsibilities. So in essence, it's telling a developing country who is not responsible for the majority of emissions in the atmosphere that they will now be facing a surcharge if they don't adhere to the rules that the developed country is attempting to impose upon them. Now, I'm not sure if anyone has had the chance to go through the 400 pages of the recent Mario Draghi, who is a former ECB president, wrote essentially on how to extract the EU from a chronic decline in its ability to compete with China and the US. But in that report, he also outlines other issues with the CBAM, such as it doesn't prevent downstream leakage, it's easy to circumvent, so you can send your clean stuff to the EU and your dirty stuff somewhere else, and nor does it level the playing field for EU exporters. But the EU CBAM is here, sort of. We would say not really. For a few years, we've been having spirited debates with many of our clients, including our good friends and colleagues at the PRI, that the EU would agree and adopt a CBAM, but when it comes to actually implementing it, money changing hands, operationalizing it, that it would have to significantly adapt itself to the increasingly new realities, such as the higher structural energy prices in the EU, which are serving to deindustrialize the bloc. And you can sense this, or more than sense this, you can see this in many ways manifesting itself, notably in the latest political guidelines from Ursula von der Leyen, the head of the EU Commission, which has shifted its rhetoric to a clean industrial policy, less focus on green, 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 and more focus on being competitive. And equally, Mario Draghi also said that the success of the CBAM is uncertain because it's complex, its implementation is fragmented, and it relies on robust international cooperation. And I think he may have been reading our earlier reports, or maybe I'm just flattering myself to think that, but he says that we should be closely monitoring and improving the design of the CBAM during the transition phase and evaluate whether to postpone the reduction of ETS allowances if CBAM's implementation is ineffective. Now, are there alternatives? Well, there are. They're not as developed, but there are. This is a heat map showing the EU CBAM versus two currently proposed bills in the US. There's bipartisan support for CBAM type structures. The US Republican version is called the Foreign Pollution Fee Act, and the Democratic version is called the Clean Competition Act. I've also included a generic construct of a climate club, which has the beauty and the curse of being both undefined but very flexible, and also has a lot of support from different international actors. Now, we can see the one commonality they have, which is the horizontal green line, in that they all incentivize decarbonization outside of their borders. They do that by charging this tariff. But they don't all directly disincentivize decarbonization within their borders by taxing their domestic industries. The Clean Competition Act from the Democrats and the EU CBAM do that. The EU CBAM is particularly inflexible in doing other things. It doesn't provide for the inclusion of other variables like geopolitical alliances or offering exclusions to least developed countries, and nor does it offer any allowance for, in many cases, perfectly credible decarbonization policies that other countries might have, but stop short of an explicit carbon price. Which brings me finally to the sacrificial lamb moment, and I'll just be going through some ways that this might be developing going forward. And first of all, thank EU, but it's probably not going to be ending up like the unilateral CBAM version. But really, we need to be thanking the EU. The amount of constraints that the EU is putting on its industry, and by extension, its consumers, and by another extension, its politicians, is truly extraordinary. There is a legally binding obligation to significantly reduce, to significantly decarbonize to a larger degree than its trading peers. It has the highest carbon price of its trading peers, and it also is mandating this slope towards zero emissions and energy-intensive industries. Now, it has put together the CBAM, which is an attempt to protect industries from the worst effects of this, but it's imperfect. Nevertheless, what has happened, that thanks to the EU, is that other countries around the world are now actively looking at how carbon intensity in their own manufacturing processes is calculated and how that impacts their potential trade flows. And here we argue is the deployment already done of the EU's most powerful weapon, and that is the weapon of negotiation, whereby the threat or prospect of a tariff has instigated action on decarbonization. 2 CBAMs will be geopolitical as well as environmental. Carbon intensity in production is a very convenient metric which like-minded state actors can use to, for example, form alliances which address historically high trade imbalances or realign supply chains. These are very important objectives, increasingly to many countries. 3, CBAMs and carbon pricing will need to factor in industrial competitiveness. I should correct that and say, and factor it in more. It's easy to eliminate emissions in your industrial complex if you just get rid of your industry. But countries are now realizing, certainly in the last half decade, that this is an untenable prospect given the costs not only to the economy, but to political stability and also the potential to have military capability. 4, and this will be interesting directly to many of you, there will be new macroeconomic challenges to face, like carbonflation. So if policymakers are raising the carbon price, certainly to a level which incentivizes real decarbonization and change, with that comes inflation. And there's been a lot of great work done, for example, by Isabella Weber, who have quantified this. It's most pronounced in the EU. But imagine the perverse result from a climate perspective that if central banks have to respond to rising inflation due to carbon pricing and how it impacts renewable energy build-outs because of the capex intensive nature of that business. 5, WTO compatibility will no longer be a constraint. This is an open secret, certainly in the US. most assuredly, if Trump gets reelected and his former trade representative Robert Lighthizer comes in, maybe as Secretary of State. But even in the EU, this is whispered a lot more. And lastly, two topics which would require even more deep dives is that it provides an avenue for carbon dioxide removal and also for climate finance flows from the global north to the global south. I've been told that these papers are in your app if you want to read more about them. We don't write much public research, but these were done for philanthropy. The most recent one is Trade, Trump, and Tractors. And the other one goes back a few years where we first started arguing some of these points. And with that, I look forward to speaking to my panelists. Great, thank you.
Okay, so while Brian comes and sits down, we have Marisol, who's Global Head of Climate Action at CEMEX. We have Nick, who is the Head of Climate Solutions at Legal and General Investment Management and a Portfolio Manager. And we have Melissa, who is from Carbon Markets Bureau, which is part of the Environment and Climate Change Canada. She's also part of the civil service, so won't be commenting really on any political matters. I'm going to hand all of those to Brian, who's going to confidently answer anything to do with politics or Canadian politics and also the future elections. Only joking, we're not really going to do that. But if you do have any questions that you want, do put them in the app. I don't see any coming through, but we will try and take them. Politics, actually, that's a good segue into our first question, which I'm going to have for you, Brian, which is you raised a lot of the points about carbon pricing being a political challenge, so might not be the only policy options that you want to have. So tell us, if not carbon pricing, what are the other measures that you think policymakers can look towards for lower emissions? You mentioned climate clubs, but do you have 1, 2, 3 favorite other policies, and why do you think we need other policy support and not just carbon pricing?
Sure. Can I come back to the first point you made when you came out here, though? Because like Nick, I live in London, the UK. I've been there for 25 years, and I'm very gladdened to hear that the UK, who built one of the largest global empires off the back of coal, no longer uses it as a primary energy source. But it's important to also reflect on what's happened as that coal phase out has occurred. And the UK has been the country that has lost the most of its energy self-sufficiency in the last 30 years. So the turn of the century, it was 92% self-sufficient, and now it's around 65%. And I say that because when it comes to taxing industries, energy-intensive industries, in an environment where there's a new geopolitical dynamic about the reliability of being able to provide them with domestic and safe sourced energy, it's just something that has to be considered in the calculus of policymaking. But to your question, what else is there? There's many things, and I will say, just ahead of Nick's also powerful arguments, carbon pricing is very important, but it can't only be carbon pricing, and there's other things which can and should be used. So you have other regulations, such as coal phase out or renewable energy targets, energy efficiency, but you also have a lot of carrots. The IRA is just one big carrot. I think there's a little bit of a stick on methane, but it's giving money to incentivize decarbonization through another tool which can be used in addition to carbon pricing, which is industrial policy. So you're choosing the industries which get support, which can also actively be front runners in decarbonization. And the last one that I would say, which sounds super boring, I admit, is standards. But standards is something which you don't need new legislation to implement to define what criteria goes into the construction of a product so that it reaches your consumers. And I think this will be very relevant for critical raw materials, where we're already seeing, and I think we'll see even in Biden's lame duck session, new multilateral agreements to create different standards for critical raw materials which bifurcate the price with China, and it can be based off of carbon emissions intensity as well.
Great, yeah, and then riffing off your first point, it's really true. In an ideal world, we want cheap energy, we want green energy, and we want secure energy. And there is a kind of trade-off between the three which policymakers argue about. And one of the critics of the UK at the moment would just point out that depending on how you cut it, UK electricity prices are really high, and that can be considered potentially as a sort of form of tax on industry or the consumer with where electricity prices are. So that's kind of a segue, maybe turning to you, Marisol, on the corporate perspective. How do you think corporations such as yourself see carbon pricing? Are they helping? Are they hindering? What's your thoughts around it?
Thank you for having me. Let me give you some background about our journey through decarbonization. Cemex is a Mexican company that has operations in Mexico, the United States, Europe, and Central America. So we are a construction material company, mainly cement and ready-mix concrete. And we define our decarbonization strategy in 2021. And setting the ambition goal of being net zero for 2050 with very specific targets for 2030. Other thing that is important in the cement industry is the composition of our scopes. So 63% of our scopes are scope 1, 6% scope 2, and 31% scope 3. So based on this, we design our strategy. Decarbonize our operations is very important, and having green products is another one, apart from circular economy and biodiversity and nature. So the largest source of profitability for us is Mexico, followed by the United States and Europe. And 60% of the volumes of our volumes are in territories with an emission trading system, right? So we do advocate for carbon pricing. We think that is the best incentive for decarbonization over time, to invest and to have time to make the adjustment. So now we have some type of ETS in Europe. We have in California, in the UK, and in Mexico. Mexico was in a pilot last year. They are starting with the ETS this year. We think that the price and the allocation are like too high, too generous to create the right incentives, but we are waiting to see what happened. And Colombia as well. Colombia is in a pilot period. But using Europe just as an example, the first ETS in Europe started in 2005, exactly. And we have been able to decarbonize our emissions by 47%. Having our baseline in 1990. And we have a goal for Europe that it's 55%. But if we compare this with our consolidated operations, we have 23%, with a goal of 38%. So for us, based on our own experience and the speed and the capacity to make investments, the most effective mechanism has been a well-structured ETS.
Great. So strong thumbs up there for ETS and carbon pricing. So maybe I'll turn to you, Nick, on the investor perspective. How do investors, you think, best understand carbon pricing, and what do you think investors and asset owners should be best advocating for?
Yeah, great question. So 3 things, breadth, depth, and badly priced. So first of all, breadth. I accept in theory the existence somewhere in the world of listed equities of a company that will not be affected by the likely rapid rise in carbon pricing that we think is coming, but I haven't found it yet. But I accept that in theory, maybe there might be one somewhere. And that's a slightly facetious way of saying carbon pricing is going to have a really, really broad impact on investors' portfolios. It's going to be felt by almost every listed company and has the potential to have an impact, we think, in almost every single traded security in some way. So that's the first thing, I think investors need to not underestimate how broad the potential impact of a rising future carbon price has the potential to be on diversified portfolios. The second is depth. So we think that carbon pricing needs to rise globally somewhere between 5 and 10-fold relative to where it is today, and that is likely to have very, very significant, and we often think underappreciated, impacts on financial markets. Part of that, we think, is to do with the very non-linear relationship between delay and cost. In other words, people, I think, intuitively think that the current slow speed of transition is going to have some relatively modest impact on the future cost of transition. But actually, there's a really exponential relationship to this because of the stock versus flow problem. So as we wait, the cost of carbon, and therefore the price that the world needs to place on carbon, rises very rapidly, to the point where we think if the world continues to delay action until the 2030s, that we may end up placing somewhere between 10 and 15 percentage points of global economic output at risk when we do then come to course correct. So that's the second, which is depth. And the third is mispricing, which is, we think, this future impact of rising carbon pricing, which we believe is largely inevitable, remains extremely badly priced by markets today. Not only badly priced by markets, we think falling through to misallocated capital by corporates. Again, we've attempted to quantify the size of that misallocation of capital. We think it's something in the region of $200 to $300 billion a year. So where does that fall out? Well, we think one of the most pragmatic steps that investors can take today, and the sort of thing we think we should be advocating for are an engagement with companies. It is around taking action today to set shadow carbon pricing and then treat that shadow carbon pricing really seriously so that you can start to pre-position in an efficient way ahead of that rise of carbon pricing in future.
That's fair. So some people use carbon pricing as a shadow, like $1 or $2. You could choose $100. You kind of prefer $200, but that would make a thing. So do you think it needs to be set at an effective level, or do you just think just by putting it in as a kind of mechanism, it gets corporates to think?
Yeah, so I think that there's a level at which doing it probably causes more harm than good. You said a sort of shadow cost of carbon of $20 a ton, and then assume that because you've set a shadow cost of carbon and you've done a carbon price stress testing exercise, that you're very, very resilient. Will then end up moving your sort of natural center of gravity backwards the wrong way because you think that everything's fine, or even encourage you to make investments that you shouldn't be doing because it gives you a false sense of confidence. But I think as long as we're moving towards pricing carbon properly and understanding what the impacts of a rising cost of carbon will be on our portfolios or on the level of corporate profitability within a corporate, we think you're likely to be moving yourself in the right direction. And we absolutely accept that there's a very high degree of uncertainty as to how high the cost on carbon needs to go to drive effective decarbonization globally. But we do think it is significantly higher than the analysis that was presented to us earlier today would suggest the effective cost on carbon is on those emissions that are subject to it are today.
Okay, that's fair. So that's a good question for you all guys in your engagement, asset owners and investors, to question whether companies are thinking about a shadow carbon price and how that might go into capital allocation and other decisions. So now, Melissa, tell us about your experience in Canada with carbon pricing.
Yeah, thanks, Ben. So I think based on the poll results and the conversation so far, I think we broadly agree that there are some really key challenges to getting a carbon price in place and keeping it in place. Since we do have a national carbon pricing system in Canada, I thought I could provide a bit of a perspective on the challenges and practical implementation. I'd say one of the really key challenges in the Canadian context has been balancing consistency and flexibility. So we've had a national carbon pricing approach in place in Canada since 2019, but there are actually a number of provinces, namely Alberta, Quebec, British Columbia, that have had carbon pricing approaches in place for significantly longer than that. And so our Canadian approach was really intended to build off of what was currently in place and what was already working. And so as a result, our approach is that the federal government sets minimum standards, and then provinces and territories can either design systems that meet those standards or adopt a carbon pricing system that's designed by the federal government. And there's a number of criteria that those systems need to meet. One key piece is a rising price on carbon that goes up by $15 a year. It's currently at $80 a ton and scheduled to rise to $170 a ton. It's in Canadian dollars by 2030. The province of Quebec has a long history with its cap and trade system that's linked with California. And so the federal government assesses that against criteria for cap and trade systems. All other provinces currently have a two-part system in place. The first piece is a consumer fuel charge that's generally designed to be revenue neutral. And the second piece is an output-based pricing system, or OBPS, for large industrial emitters. Under an OBPS, facilities have a performance standard that's based on emissions intensity per unit of output. Firms that emit below their standard earn credits that they can either use themselves or sell on the market, and firms that emit above the standard owe compliance obligations. The opportunity to earn credits creates economic value for all emissions reductions, but requiring firms to pay only on emissions above the standard helps to protect competitiveness and avoid carbon leakage. Most provinces have opted to implement their own OBPS instead of the system that's designed by the federal government. And there's actually a fair bit of flexibility in terms of how provinces can tailor the design to their specific jurisdictions. And so frankly, that means they're all a little bit different. So for example, they can set standards at different levels for specific industrial sectors, provided that the system as a whole meets the minimum criteria. Similarly, there's a number of different approaches that they can use to recycle those revenues, again, subject to the constraints of the minimum criteria. And so what effectively this means is that there's a number of different carbon markets in Canada instead of just one. Most of these markets are still relatively new. We're expecting industrial carbon pricing to be really a major driver of emissions reductions in Canada. There's independent research that estimates it will deliver somewhere between 20 to 48% of the reductions expected from Canada's emissions reductions plan, which is our pathway to our 2030 target. And so that means it's really an important policy to get right. Part of the role of the federal government is to conduct regular reviews and assessments to ensure that that flexibility provided for system design is continuing to deliver those consistent outcomes.
Great. So we have a lot of ideas about doing more policy, but I thought I would maybe throw out just one quick question before turning to audience questions about maybe one thing we are currently doing that in an ideal world you would just stop. So if there's one policy or one thing that actually we should just roll back, that wasn't a good idea, or maybe it was never a good idea, and we would maybe stop. So I'm going to throw it out there. Brian, what would you get rid of?
Tempted to talk about hydrogen, but I'll refrain myself.
The second choice.
Certainly, hydrogen and home heating. I guess for this crowd, I would say to embrace the opportunity of unbundling ESG, and let's not be afraid to do it.
Okay. Bundled up ESG. Great. Melissa, is there one thing you would stop in the world?
I think that there are a lot of really unhelpful assumptions about carbon pricing out there. This is such a complicated space in a lot of ways. I think we've heard about a lot of different tools and instruments and approaches already. And I think it tends to get painted with this sort of broad brush, or there's a lack of recognition sometimes that people are coming to this conversation with a different knowledge base. So I think for those of us that are really convinced that carbon pricing is a very effective policy tool, we should maybe stop assuming that that's so obvious to everyone.
Right. Yeah. If it was so obvious, why isn't it going a little bit better? Right. Marisol, is there one thing you'd get rid of?
I agree, but I think that we have to realize with how many biases we get to the table to analyze a mechanism like CBAM or an ETS system, right? There is evidence on the table about the results. So I think that we have to start from scratch, analyzing what is working and what is not working.
Great. And Nick, what would you delete?
So I'll be provocative and say arbitrary deadlines for phasing specific things out, rather than letting market-based mechanisms determine the pace at which we deploy different decarbonisation choices in the system.
Yeah, so you think a point year or point estimate is too arbitrary. Fair enough. Great. So please do keep on putting in questions. We have a question here coming through. Oh, you should give thumbs up to the ones you most want answered. So I'm going to go pick one of those, which is what are the prospects for increasing the connectivity between voluntary carbon market into regulated carbon markets? Could we see anything around voluntary credits increasingly be accepted by compliance systems? We have one comment around the fact that Europe did allow offset CDM in its early stage, but not now. So I don't know anyone who wants to take that one. Maybe Nick, and then Brian can make a comment if he wants, Nick.
So
Yeah.
in theory, this is a really, really great idea as long as it is properly designed and done with a really, really high quality standard of overlay.
Right.
So I think you need to have proper stacking, and I think proper vertical and horizontal stacking is essential to allow genuine fungibility. And I think there needs to be really, really careful consideration around how much you allow for voluntary carbon credits, which would therefore not be voluntary anymore, to be substituted into compliance markets. But in general, we think that the changes to the world's land system need to bear around 1/3 of the economic effort of getting us on track for reaching net zero. And today they don't get anywhere close to 1/3 of the effort or 1/3 of the economic incentives that are applied. And this would be a really, really fantastic mechanism of doing that, as long as we do it really, really carefully, cautiously, and thoughtfully, and with the highest standards and full cycle standards upheld in the process.
Yeah, it's that really careful bit, because voluntary markets have been quite criticized by a lot of people because they're kind of quite tricky. So I don't know in practice, but I don't know if anyone else wanted to comment either on voluntary or that.
It's such a loaded space. What would I say? It's an area where you're putting your emissions off balance sheet and not, as a result, not having to reduce your own emissions, I think, conceptually is an issue. So they need to be really, really, really high quality. And, we can also think about a little bit of the contradiction of the CBDR, where a developing country needs to pay as much as 60 or 80 euros to export to a developing country, but yet they sell a ton of emissions in the voluntary carbon for $1. And something's wrong there. So I think the marginal cost that those need to be sold at is much, much higher, and the quality of them needs to reflect that.
Great. Okay. We have a question here, and I'm interested in the panel's views on investing directly into carbon allowances. There's some research that suggests that there could be interesting opportunities for portfolios, particularly in Europe, and whether this would be a viable asset class. So I don't know if that, we also have a comment on that, is to reframe this as an alternative asset class, can regulated carbon markets just provide uncorrelated returns? So therefore it'd be just a good investment, I guess. I guess this is an investor one for you, Nick, but anyone else can also have a comment.
So obviously we have to be really careful to not be giving any investment advice when you answer that sort of question.
Right.
The challenge we have as investors is that almost everything we own has a negative price sensitivity to the cost of carbon, i.e. as carbon costs go up, nearly everything else we own goes down in value to varying degrees depending on what it is that you own. A few exceptions, but generally speaking, we've got this negative exposure, and we're really, really short of hedges. And exposure to carbon markets in general have the potential to act as positive hedges. But I think you have to be really, really careful around dabbling in compliance market type systems where there is a huge degree of exposure to political questions and policy questions, which have the strong potential to impact on the price and value of those investments. But in theory, extremely attractive for the potential role that they have to play as hedging us against uncertainty around the pace of climate action.
Great. And that is not investment advice, but yeah, interesting thought there. Did anyone else want to comment on that?
Well, I would just say it's not a market-driven, pure market. It's semi-controlled by policymakers, and there's 3 or 4 different issues to be decided right now in Europe, which would impact the supply of emissions allowances. So it's very supply and demand driven, and there's also the political pressure to, if another 100 billion is needed for something, then just sell a bunch of allowances to create the money for that. And that becomes not something which is correlated to an emissions profile, but to break in the piggy bank to find some money.
Okay, that's fair. Question here. There's an assumption in this that ETS prices carbon, but the money is not used to reduce emissions. It's just a tax. It is a pricing thing. 95% of carbon offsets are avoided emissions, and the other 5% is carbon sequestration. So should we just concentrate on the 5% on the sequestration side if that's what needs to be done to control climate change? Anyone have some views on that?
Well, I can jump in.
Yeah, please.
Well, we think that the proceeds of the CBAM should be allocated to decarbonize the hard to abate industries. So we think that that's super important, and it has to be related to all the value chain as well, right? So that's our thought. And talking about CCUS, or what do you do first, right? For Cemex, and this is unlike other companies from the same industry, our strategy has been reducing before capture. So we are activating levers to reduce our CO2 footprint, and these levers are profitable. And it has been easier, as I mentioned before, in Europe because of the ETS, right? What happened with storage? The carbon price that we have now in Europe is not enough to make that investments profitable. So maybe we should see a higher price in carbon to incentivize those type of investments.
Okay, that's fair. I guess some critics say the tax is regressive on low-income households. So maybe we should be giving some sort of carbon dividend, either as a total benefit or to low-income households, rather than for carbon for hard to abate sectors or green. And then there's a big fight about, well, tax money, and everyone wants some of it, right? Each department will want some of it. But in this sense of regression, do you think that's something that we should also lean towards because of the political economy question, or should it just go into green innovation or sequestration? Does anyone have a view on that?
Yeah, I mean, if you look at where ETS revenues go, they go to a split between, I think, a quarter, may have this wrong way around, the quarter to the EU and the rest of the member states. And in the ETS2, which is coming up on buildings and road transport, that is to go to a fund which then gets redistributed to people. And I think it's imperative to get buy-in on this very difficult political decision from people to see the benefits of that money. And it is a regressive tax. You know, everyone has to pay it, but the people who have less money, it impacts them greater. So, you know, to use that as an income distribution mechanism, I think those are entirely appropriate, you know, questions. And if you look at the way these other CBAMs are constructed, the Clean Competition Act from the Democrats is going into climate finance internationally. So that's like that connectivity towards solving another contentious issue, but also to helping domestic industries decarbonize. So there's a whole range, but just to put it into a fungible balance sheet and use it for whatever you want to, that's a recipe for disaster.
Right.
Yeah, just on the revenue return question, I was just going to jump in with kind of what we're doing in Canada, and that question whether it's regressive, because I think that this is a story that doesn't always kind of rise to the surface of the debate as well. So in terms of the proceeds, everything that's collected goes back to the jurisdiction of origin. And in terms of the consumer fuel charge, the funds collected are almost all recycled to Canadians and households. And so those payments are called the Canada Carbon Rebate. Typically, 8 out of 10 households receive back more money than what they pay in the carbon charge. And so that really does help to manage those regressive impacts. And it typically is the lowest income household that benefit the most from those payments since they're equal. And then on the industrial side, again, there's a few different approaches, but typically the revenues are invested in technology and decarbonization projects at various stages of technological readiness. So that also helps kind of move along that research agenda as well.
Sure. I haven't seen the recent surveys, but it certainly doesn't seem that public opinion feels that they're getting their money back. So again, this is a thing that maybe if we're advocates and there is this redistribution impact wherever it's going, people can actually feel that actually, well, they should have been a net beneficiary, even if they don't sense that. We have another question here, which is to the top, which is slightly adjacent to this, but it's around why there shouldn't be more scrutiny on net zero claims via voluntary carbon offsets. And we did touch about the problems about the voluntary market. But the further comments are on reconciling these different carbon prices. So EDF pays 80 euros. I think some people are paying 100. Some US tech names are maybe paying $10. I think some people I know are paying $1 within that. And the challenge is if we don't use offsets, would that not underwrite new renewable capacity, or does anyone think about this kind of different use of prices and the voluntary market? Anyone want to take that? No one go for it. Nick, do you want any comments or?
Yeah, we think you should take voluntary carbon markets and divide them into two very clear groups and treat them completely differently. You've got avoidance types of voluntary carbon credits, and you've got removal types of credits, and they're totally different things, and we should never look at them and compare credits of those two types in the same way at all, because they do not provide the same economic utility to society. They're of just fundamentally totally different quality. And a lot of our confusion comes from the fact that we bundle these things in together and we treat them as though they're this sort of homogenous thing, completely different, right? But that's not to say that carbon avoidance is in and of itself a bad thing, right? It's clearly not a bad thing. It's just it's not at all equivalent in any sense at all to a positive ton of emissions. We don't generally think that carbon credits should be being used to get companies on track to hit their net zero targets. They're things that should be thought of in addition to those, at least for a relatively long period of time, whilst we're incentivizing corporates to be doing primarily abatement activities, and that this is a question for the late part of the 2030s and 2040s when we start to get into really the expensive parts of MAC curves for corporates.
Sure. So yeah, different bucket, and the ideal aim is for real world absolute emissions to fall, but obviously we have all of these things in the meantime.
I would like just
Please.
to add one thing about the cement industry. We have our targets aligned with Science-Based Target Initiative. So we cannot offset our Scope 1 or Scope 2. And in 2050, we could offsetting 3% of our residual emissions. So there's no space to greenwashing with offsetting, basically. We have to focus on decarbonizing our operations. And about the voluntary carbon markets, that I think that play a fundamental role for many industries, particularly with Scope 3 emissions for some companies, right? So what I think is that that's a market that has to be much more strong, like with environmental integrity. And I think, for example, the Article 6.4 or 6.8 of the Paris Agreement, when you can like offsetting, helping emerging countries to decarbonize, it's a good instrument, right? So the market has to evolve and be much more reliable.
Okay, that's fair. We have a question here about kind of Canada, but it would apply to other countries as well. But it's really a side effect of what China's doing. So the question is, China's been rapidly embracing clean energy, reducing the carbon intensity of their goods. If Canada and other countries don't keep pace, could Canadian-made goods or other country goods be on the receiving end of a global CBAM? And I guess this is also the idea of, do we get a global fungible market? And is it a race to the top, race to the bottom, or something like that? So anyone on the panel want to take this idea about where China's leading and where others might be on a global CBAM?
You can get quickly lost in the numerous technical aspects of who would be, negotiating successfully the common CBAM. And you can look at the repeated failure of the EU and the US to negotiate its global agreement on sustainable steel and aluminum, which fell apart even really before it got into the emissions intensity boundary discussion.
Didn't even get there.
It didn't get there because the EU wanted there to be a carbon price, and the US wanted some ability to block out overcapacity in steel from China. So those are just three separate issues which start to reveal the complexity of trying to unify different versions of what a CBAM is. But China, from what we are discussing with people in China and companies who are dealing with companies in China, are really waking up to what this means for them, and they haven't come to a universal answer, but they're looking at this going, wait a minute, what? If we send something that is steel made from a hydro facility, it's green, we'll just send you that. And the EU is saying, no, it should be average. So it quickly becomes political because you don't want to disenfranchise your industry. So can you translate China's monopolistic position in clean energy technology and components and CRM processing into its ability to dictate a CBAM? No.
Yeah, political economy challenges. Great. We have a couple of interrelated questions here on science-based carbon pricing. So we have one which is for the panel. Does the panel agree that a science-based carbon pricing system should be introduced as a way of encouraging investors to take notice of how firms manage unabated emissions and the risk of future carbon penalization? And then we have another, which isn't one of the biggest problems the fact that carbon markets lack a real-time, ideally science-based connection with the underlying? So this idea of more science-based carbon system and just giving either investors or other stakeholders within that. Any thoughts on those questions?
So in a very, very sort of ivory tower view of the world, this is why cap and trade approaches are better than taxed sort of price-based approaches, because you can tie your constraints to science-based targets, whereas setting them with hard prices, i.e. where you use a tax that rises over time, is harder to technically link in that way. But I think we're arguing over which of two good things is the better, whereas we're clearly not having either of those two things, so it's too obsessed around it. But I think the short answer to both those questions is yes. Yes, I completely agree with the sentiment behind those questions, I think.
Yeah. Yes, in theory, but we're so far away from it. Let's get anything that we can get. Okay, we have one here which kind of touches on cement, but I guess the assertion is that how will carbon tax affect industries that can't really lower carbon emissions like cement? So this is the kind of hard to abate, but one of the counterexamples is that actually your intensity has gone down over the last years. But they suggest that this is maybe 3 billion tons a year in hard to abate sectors, and this is well beyond capture. And does it really encourage less sustainable building materials, or what's the issue with whether you have substitutable products or not? So I guess the question is, how will carbon tax affect your industry if you don't really think, if there's a lot of emissions that you can't really abate?
Well, we have ambitious targets for 2030 in terms of ton of CO2 per cementitious ton of cementitious material, and I think that part of the roadmap for 2050 is carbon capture and storage as well. So we are investing a lot in research and development. We are trying and piloting technologies, and we are as well. I think that for some very high or expensive projects, we need blended finance, and we need grants from the government, from the IRA, from the Innovation Fund, and we are confident that we are going to get there.
Okay, please.
Can I just add there, if I understood the question correctly, yeah, are there going to be residual emissions which you can never get rid of, especially in cement, where a lot of its process emissions is quite difficult? Just to highlight that goal of zero that the EU has in 2040. If you talk to them in Brussels, they're like, yeah, it's not going to work. But it's still there. Maybe it's aspirational. But it also lends itself to this debate around the inclusion of removals. And if you can get removals into an ETS, they need to be, cheaper and better, obviously, but you can treat them as a free allowance. You can treat them as a discount to a tax. So there's going to be something left, and this is something where removals can come in.
Great. We have a question, I guess, directed at you then as well, is what is your expectation for growth in the percent of the global economy, because market covered by a carbon price or trading markets? If it's, I think you said 25, 27% today, where do you think that could grow in, say, 5 years' time or 10 years' time, or even near term?
Well, I don't have a specific answer. I guess I should, since I had all those numbers up there. But it could be 50%. It could be more. But the question is the price real? And is the price being passed down? That's the more important aspect to me.
Okay. Keep the questions coming in. We have a few more, which is, so here we have one. What views do we have on Article 6 in the Paris Agreement? This is in terms of making progress on delivering on international carbon markets. So we kind of touched on this. I'm guessing we're saying political economy issues, but does anyone want to tackle how are we doing on international carbon markets and getting on Article 6 in Paris Agreement?
I have colleagues that are really good at that, but they're not sitting in my chair, so I'm going to pass.
We're going to pass on that one. It's not doing so well, I guess, on that. Anyone else want to? Okay, we'll come back to you. We've got another one on this.
Give me a call. Give me a call. I'll get you a better answer.
I think we're not doing that well is the short answer, but we'll get some details on that. We had one, it's just moved. What is our view on investor policy engagement? So what should we be doing on carbon pricing as investors and pension fund asset owners? And has there been any particular financial institutions publicly advocating? Maybe in the Canadian context, are there any Canadian institutions particularly advocating? And I guess some companies as well. So from the corporate side, are corporates advocating for this? So should we be advocating more? And what kind of should investors or corporates, what should we be thinking of? Nick, maybe you could do the investor side. And
Do we think we should be advocating for effective carbon pricing? It's always difficult to argue that we should be lobbying governments for anything, because we want to be really careful around suggesting that any particular set of policy measures. I think the best role we can play as investors is devoting the time and energy and resourcing to making sure that we're able to understand what the financial implications of it will be, and to be able to demonstrate the really overwhelming financial case for governments to act now on this issue rather than to act later. And I suppose our best sort of positive, constructive role that we can play, in my view, but then I'm slightly talking my own book, given that this is what I do for a living, is to do the highest quality research we can to show from our position of expertise around financial markets that acting now leaves the world bearing a relatively modest carbon price compared to acting later, where we have to bear a really, really high one.
Sure. And actually, there's quite a lot of corporate industry groups which do seem to be moderately positive on it, but I'm not sure on that. But I don't know if you have a perspective on the corporates or what corporate industry groups are thinking.
Well, we as a company, we advocate for emission, for a carbon
ETS,
price.
yeah.
But it's not only as a company. We are part of the GCCA association that advocates as well for a carbon price. And apart from the advocacy, I think that there is another side of this, and it's how to activate the demand for green products and public so we are in an initiative, the First Movers Coalition, who try to advance to grow the demand for green products, right? So that way, if you activate the demand, but if you activate the public demand, like governments buying green products, so then you close the loop, right? Of having a strong market around carbon prices and green products.
Yeah. Okay, that's clear. Okay, so this is a tricky one because it's around beyond value chain mitigation. So I'm not sure if any of you guys have heard of this one, but the idea is implementing BVCM, beyond value chain mitigation strategies, something that anyone is looking at or considering in terms of tackling unabated Scope 3 emissions. So do we have any clue on that? Nope. So that's score one for the audience there on something that we don't unfortunately know that much about. And then we have another question here on discussions on phasing out existing subsidies to fossil fuel sectors. Do you think that's part of the conversation on carbon pricing, and how should it be interlinked? And what do we think about the subsidies to fossil fuel sectors in terms of CBAMs and the like? Go, Brian.
I mean, it's so obvious to me. It's so politically charged at the same time, but the essence of what we're trying to get at is to create sustainable green premiums for these things which are, the market is telling us, are uneconomical at the moment. And you can do that in the numerator or the denominator. And giving fossil fuel subsidies is making that green premium that much more unachievable. And it's the easiest way to collapse that green premium without spending tons of money in different directions. I think it's the easiest, not the easiest, anything that's not easy. It is the most effective thing that the globe could do right now to accomplish a lot of things.
Okay, great. We also have another tricky question here, so we might not be able to do this one, but this is the idea that perhaps there are different types of shadow prices that are important. So if you add in other policy things, you have a different implicit price of carbon in the EU. And should we think about that, and for what domains or for what actors is it useful to calculate and imply a different sort of implicit price by thinking about all of the other policy regs? Nick's going to take this one, I can see. No.
No, I mean, I will. If I don't want to dominate the panel, because there's lots of perspectives here which I'm sure will be useful. I think this is definitely a really, really big problem, right? In that, this is what we were talking about before we came on stage, that the more policy measures, and particularly direct policy measures, that you throw into the melting pot, the harder it becomes to see for any given ton of emissions what is the effective price that is being applied by the net system effect on that ton of emissions. And the less easy it is to see what that cost is, and then crucially to predict what that cost will be in future, and I think it is that second component that may even be more important than the first, the harder it is for emitters to make efficient capital allocation decisions today to invest to make sure that the right tons are exiting the system at the right point in time. And that, I think, is the really, really crucial issue about these complex, effective prices that result from a melting pot of direct and indirect and transparent and opaque policy measures, which all get mixed in together.
Right, and that's why, in theory, people like just going for the root cause at the top rather than that. Okay, and we have a question. We kind of touched on this, but this one is around whether there's enough thought about the need for a decent carbon price for carbon capture to work. And can carbon capture work in the absence of a really high or decent carbon price? So we've talked a little bit about this kind of residual effects on that. But anyone want to take that? Go.
Yeah, and maybe this is kind of building off of Nick's last point as well. Like I very much see carbon pricing as a yes and policy, where a carbon price alone is often not enough to make these big bets and big investments on things like carbon capture. And And so I'd say really, like, we were talking about coal phase out earlier as well. I think that's another example where in Canada, there's a regulation of no unabated coal past 2030. And so that has driven some investments in carbon capture. But then, carbon pricing came in and I think has helped to really accelerate that coal phase out and those other types of investments as well. So definitely agree that there's sort of that risk of regulatory overlap and confusion in that space. In Canada's climate plan, we have 140 measures and, there's inevitably some inefficiencies and overlaps there. But in terms of kind of looking at which tools are best placed to do which things, I think carbon pricing is always a piece of it. But for things, like those big shifts like carbon capture and other major industrial decarbonization investments, often you do need those other supportive subsidies or regulations or other types of tools on the table as well.
Great. Okay, well, I hope we've answered a load of your questions. I don't think we have any new ones coming in, so that's well done to the panel for taking some really tricky ones there. So I might actually ask for the poll again and see how we're feeling. Are we as negative as we were? I think we actually saw some decent answers to some of these questions, and maybe we want to do a better job on the education side. So how are we feeling about the state of carbon pricing now? Well, we're still neutral, negative. No one's turned more positive. Oh, we've got some. You're all not on your apps. Is that still? Yeah, I think this has turned a little bit more positive. A lot of people are now just in the neutral camp. Okay, great. So I'm going to turn to one last question as that's going through. Yeah, okay, people are kind of neutral, still leaning a little bit negative on that.
Maybe neutral means yes and.
Yeah, maybe yes and yeah, exactly. But that is a shift in opinion, so that's quite good. I also will remind you, I think in the app, you can do a survey. So you can give us 5 stars if you want more of this. Please like and subscribe. No, that's YouTube. But so if you want more of this, do that. Or add some comments about, why we couldn't take any of your questions or answers or any more that you want on that. Feedback is really nice. And we like 5-star reviews because that's how they've done us. So calling to the last question then. So we have kind of a minute on this each, which I guess is your final call to action. What would you most want people in the audience to take away and to think about? And we'll go maybe start with Nick and come in. So Nick, what's your one final call to action for us?
So I don't think it is an exaggeration to say that being optimistic on climate action means being optimistic on the uptake of carbon pricing at realistic and effective levels. And to have this level of conviction, this is such an important, crucial issue, but that if deployed effectively, has the potential to drive the millions and millions of individual capital allocation decisions that really have the potential to move the needle on global emissions.
Great.
Well, I could add, let's make that money goes to companies and solutions that are really being effective, basically.
Great. Melissa?
I'd say from a policy perspective, policymakers really want to understand what's needed to unlock decarbonization investment. We want feedback on where the barriers are and what's needed to overcome them. And I think also want to know if there are ways in which policy design is having unanticipated impacts that need to be fixed, even if sometimes those fixes can be slow or complicated. And I'd say really policies can often be made better through a process of constructive complaint, and there's that space for creative solutions that we can find. So maybe just as one quick example, there's a public investment vehicle in Canada called the Canada Growth Fund that's establishing carbon credit offtake agreements for specific types of projects, which aim to provide certainty on minimum prices for carbon credits and accelerate investments in clean technology. And so while that's definitely not a full solution to policy and price uncertainty, it is an innovative way to contribute to more market certainty. And so I think I would end by really echoing a lot of the calls that we've heard from panelists over the last day or so on engagement and to encourage engagement with policymakers to bring forward those constructive complaints or better yet, solutions.
Great. Brian?
Mine's related. I would say that so we advise governments, we advise large asset managers, renewable energy companies who are seeking a lot of clarity, and the policymakers don't have all the answers. but keep asking the questions. You know, we speak to companies that want to do multi-billion-dollar investments into batteries in the US. And they're just like, okay, will this work? Will this work? Will this work? And then we go to the policymakers and say, will this work? Will this work? Will this work? And they go back and they think about it. They're learning as they're doing right now. Don't take everything as, you know, negative or, you know, things aren't developing. The questions that you ask now are informing the formulation of policy. And can I just say that I have SOC envy?
Right.
Before we get to the end,
Yeah.
I learned before this that those are climate socks.
Yeah.
So it was my first PRI, and I feel bad that I don't have any. But
It's our secret code.
thank you, Ben, for telling me that.
So on that, if you want more on this, and there's some work the PRI has done with inevitable policy response. There's some stuff on the app for things that Brian referred to, and give the panel 5 stars and some applause. Thank you very much.